Good day, fellow investors. BlackRock stock, however I look at it, is a buy for a minimal 2x. And Larry Fink was recently discussing how everything he does is growing, and given the future tokenization and everything, how BlackRock is just about to continue growing. But let's discuss a little bit of beef. When Griffin from Citadel was asked about tokenization, he says, what a great opportunity for shysters. I mean, let's just go ahead and unleash the worst of animal spirits. Let's find a new way for retail America to just get absolutely hosed. And that has been the discussion for the last decades, as we'll discuss in this video, between passive investing, BlackRock just piling money, growing, and let's say a little bit more of a cautious way of doing things, where BlackRock is now pushing, with deregulation, liberalization, growth everywhere, for 401ks to even be able to invest into private equity. So all these structured products piling keep on growing. And given the politics, given the lower rates pressure, given the growth, given the who cares, let's borrow as long as we can, it is most likely that BlackRock will keep on growing, and therefore you can double your money in a few years. Let's discuss BlackRock, the recent earnings, the growth strategy from the investing day, the financials, make a stock valuation, and then perhaps touch on the risks if there are any. So, BlackRock earnings, we go in, and of course the key of what they do is just fees on their assets under management. They just grow it as much as they want. The bigger it is, the better it is for Larry Fink. The more inflows it gets, even better, even higher. So as long as that continues with positive retail, with positive, especially positives, ETFs growing, and then all the other alternatives, it is a huge positive for BlackRock. But then on ETFs, we have also Paul Tudor Jones discussing how there are 500 levered ETFs, 300 in the making. Everyone is offering those ETFs. BlackRock is winning there, but that is another perhaps risk. However, we don't know whether it will ever materialize. And for now, they are just growing their operating income and their net income, increasing, growing into markets, into this, into that. They are paying a growing dividend per share. They are buying back some shares, but they are doing acquisitions, diluting a little bit compensation. So we can forget about the buybacks, focus on the dividend that will likely grow even next year, 540 and so forth. When did you come to their revenue? Most is fees, lending revenue, performance fees, some tech, distribution fees, things like that. But the bigger the pie, the more the fees BlackRock makes, and they are going into alternatives wherever there is trade, wherever there is capital flowing, tokens, whatever. BlackRock, as soon as it will be profitable for them, quickly goes there, and therefore they make more money. So the more the financial environment evolves, grows, the more BlackRock benefits. That's how it is. Now, we look here a little bit at the earnings, and they have a big difference between generally accepted accounting principles earnings and as adjusted. So that's something 20% here, which is significant when it comes to investing. Okay, 2023 it was a little bit lower. Here again, same adjustments there. So there is a lot of adjustments, impairments, things like that. So personally, I would take this one as the conservative way of looking at earnings. Here they say how they adjust impairments of intangible assets, acquisition-related costs, things like that, but they keep doing that. Okay, if you just want to look at the business, then you can look at the adjusted numbers. If not, you can then look at the real numbers. But anyway, the market will look at the adjusted, and therefore the numbers will look better, everything looks great, and BlackRock stock will keep on growing. Let's discuss a little bit BlackRock's business. Great investor day, 150 slides of presentations, and 2024-2030 aspiration, 35 billion in revenue. If they increase the margins, that's a 2x in the company. And you can see they also put it on slide 6 of the deck. They say market cap 2 double. So they are telling you 2x here. Look at this, 2x. Incredible. So just buy BlackRock and continue. And they are going everywhere, growing private credit, ETFs, technology, infrastructure. Now they want you for 401k to even put in private credit, because the only way to grow is to just put more money into it. Insurance, wealth, digital assets, tokenizations, active ETFs now, even going away from passive, whatever there is demand for, or you can market it or you can create it. Acquisitions for growth. This is smart because you acquire smaller businesses and then you implement into the larger ecosystem. So nothing wrong with that. I would do that too. 400 billion of cumulative fundraising in private markets by 2030, reinvesting, building. And as always with private markets, keep in mind the stock market is shown on a daily basis, prices go up and down. With private markets, you buy it once, you say every year the value is now 10% higher, you bank your fees every year, and that's how the party has been going forward for the last 15 years. So they also want a piece of that private pie. But BlackRock made an offer to buy the ports, global ports from CK Hutchison, and they offered $19 billion or something like that. The thing is that you, as a retail investor, that's how you get hosed. You will now be allowed to invest in private equity, you will look at the great numbers they are marketing, and then you put your money into private equity thanks to BlackRock. That will get your fees, etc. But they are paying 20 billion for these ports. You can just buy those same ports for a fifth, let's say, yes, a fifth of the price if you buy CK Hutchison yourself. That's the difference. By the way, I'm long CK, so I have to shut up. More on that on my research platform if you are interested. But private equity doesn't care about price. We investors care about price. When private equity buys us out, we make some money. Still, there is an opportunity, but okay. Nevertheless, the best are getting bigger, so they are enjoying these flows, and that's what Larry Fink likes. And this is likely only the beginning. Wow. So 2x, and then even more 2x, and 2x, and for eternity. So just buy BlackRock and forget about anything else. And they're right. They will establish themselves across the ecosystem, tokenization, tokenized funds, everything will growing. But what is growing before tokenization is ETFs. If we look at the charts here, ETF growth 27 trillion, 15% growth forever, so just still huge market growth. Let's just buy ETFs. You get convenience, conversions, scale. Everyone is concentrating into the same assets. Invest by market capitalization. Forget about everything else. iShares is the leader, and what iShare does, everyone else follows. So we have this crowd going into one peak to get it bigger that Larry Fink likes. And you can see here huge growth, how it's exponential growth, amazing. Digital assets, ETFs, Ethereum ETF coming, everything there, great. European ETFs at an inflection point for the next 7 years. European ETFs will grow. That's great for us in Europe. Innovation, always something new from a traditional portfolio. Let's lower the fixed income. That's boring. You don't need to pay that much fees. Let's go to equities, global, regional equities, active ETFs. Why? Why to lower this? Because we can get more fees on this, and they will get, and they are making money by making you pay more fees, more attractive things, democratizing. So nothing wrong with that. Larry Fink is extremely smart. He's playing, going for the ride, doing everything. He's doing everything perfectly, no matter a little bit of irony because of the hosing. I will not get hosed, no problem for me there. I make money as Larry Fink make money in different ways, not on the fees that he gets, but you can also make money by buying BlackRock and not be hosed. That's also a plan. Infrastructure, golden age of private infrastructure, so everyone will invest now privately. Infrastructure, digital era, trillions and trillions going into gigawatts and things like that. There is a huge infrastructure funding needs. Why there is such a huge gap between the funding needs? Because you need a return on investment on that infrastructure to do it privately. If not, the government needs to do it. The government is borrowed to the neck, so they can't do that. Let's discuss financials a little bit. If we look at financials, just growth ahead, conservative, this might be 8% if all goes as planned, good margins, capital management, repurchasing, dividend going higher and higher. So as the dividend grows 10%, your stock will grow 10%, perhaps even faster as this is confirmed, and that's how you double your money. They have been growing across all environments, so all great there. Diversified, ETFs, alternatives, private markets, everything great. So they do these acquisitions constantly and they are implementing them into the ecosystem. Great thing to do. Returning capital to shareholders, doing the buybacks, but also issuing shares. So focusing on those dividends. And if they grow, if they double the dividend, if they do that, that's again a 2x. Let's compare if the 2x is real compared to the current stock situation. 15% per year, as I said, growth. If they continue it, that's 2x in 5 years. As the dividend doubles from the current to 20 to 40 bucks, that's it. And they have their fees, their structure, everyone is investing in that way. So I don't see why this wouldn't happen. If we compare it to the price, well, at these valuations, the P ratio is 30, maybe. So that's all good. If you look at the adjusted is 20 for, what was it, 10%, 15% dividend growth going forward. I think that this trend that has been there since inception, growth ETF, will likely continue. You might not even double your money in 5 years, but in 3 years, because if the market really gets it that this is just keep on growing, then it will be paying a premium, so you can still get in on the ride. So if I have to put BlackRock on my quadrant, it's simply the best buy. You buy it here and you get 10% per year for the next 5-10 years and sell everything else. Especially sell the S&P 500 and buy BlackRock. It's more diversified, it's growing faster. Okay, are there any risks? Probably not, but we have to discuss them because we are a boring value investing channel. Even Jerome is bending over to get BlackRock's big one and lowering rates. So that's something, because I guess people in the States are dying of hunger, poverty all over the place, so they need to lower rates. Okay, even Paul Tudor Jones says it's crazy, but the Nasdaq, the BlackRocks will double in the next 6-12 months as this party keeps on going. Trump wants even lower rates. Powell says exactly what Wall Street wants to hear, so Trump has gotten to Powell. And 10 Fed rate cuts, so the new Fed chairman will be extremely bullish and print more money. If low rates don't work as planned, they will simply start printing money. The government will buy these ETFs. They're already buying stakes in companies. So Larry Fink is dancing. But on the risks, let's go to 1985, Warren Buffett letter to shareholders. Most institutional investors, BlackRock, in the early 1970s, 2020s, on the other hand, regarded business value as of only minor relevance when they were deciding the prices at which they would buy or sell. This now seems hard to believe. That was in the 80s, but we are in the 2020s, and this is now again what's going on. However, these institutions were under the spell of BlackRock at prestigious Wall Street institutions who were preaching a newly fashioned theory. The stock market was totally efficient, and therefore even private equity is totally efficient, even if it is private, and therefore calculations of business value and even thought itself were of no importance in investment activities. Just buy ETFs, alternatives, tokens, everything is going up. We are enormously indebted to those BlackRockians. What could be more advantageous in an intellectual context, whether it be bridge, chess, or stock selection, than to have opponents who have been taught that thinking is a waste of energy because everything is just getting bigger? The key question is, does price matter at all? And is that perhaps the key risk? So this was Buffett. He's been investing for a long time, but can prices go lower? That's the key question. Because if we look the early 70s, we are now something like that after the 60s, huge tech advantages, this and that, and 10 years later, the market was down 60% if you look for inflation. If I don't look for inflation, the market flow was 10, but real returns were very negative, 60% down. The market, adjusted for inflation, to get to zero from the market, you had to wait 20 years. If that happens, that would also be very negative for BlackRock, as there would be no more growth. On top of that, back then the government could do things, increase rates, save the situation, because debt to GDP was 30%, not 120 as it is now. Now, will ever the not thinking, buy Bitcoin, buy gold, buy ETFs, just plow your money into, I don't know, Italian bonds at 2% with my pension fund? Who cares about the clients that might get hosed one day because you're not making any money? So I hope from the bottom of my heart that not thinking and investing because everything goes up will not become an issue. Because now they lower rates. If that doesn't work, they'll print money, they'll release inflation. Who makes the most when it comes to inflation? BlackRock. Assets under management just inflate higher, fees inflate higher, and BlackRock keeps on growing. So whatever happens, crisis, lower rates, money printing, BlackRock makes money. Great economy, everything goes up, BlackRock makes money. So that's probably a win-win situation for BlackRock. Whatever happens over the next 5-10 years, they should do well. So that would mean I should keep BlackRock there. Now, personally biased, I would put BlackRock here as high risk because things might change, but we have to keep it here. What can change? 10 years ago already, Carl Icahn was discussing BlackRock as an extremely dangerous company, and those that listened didn't make huge gains. What was going on? Already then, ETFs are overpriced and extremely illiquid. He thinks that they are going to blow up, and that can happen. ETFs can blow up and BlackRock can blow up. That's a risk. And even Icahn then was discussing the same things we are discussing now. Low interest rate party bus. Then there was Yellen and Fink pushing the bus, but he said it might hit a big black rock. Now we have Trump that managed to put pressure on Powell to lower rates, and if we read the discussion, then every now and then Janet wants to put the brakes on it. Powell wanted to put the brakes on it. Larry says, no, let it go. And the people in the party are yelling, no, don't touch those brakes. This is fun. Everyone is making money. They are moving towards this cliff as BlackRock and stocks go higher at a faster pace. And the cliff is there, and this is going to go all over the cliff, and you know what's going to destroy. They're going to hit a big black rock. That's what I'm saying. You have to do what you have to do to Larry Fink, and he has been doing like that. And he says around, I've been around a long time, saw it in 69, 74, 79, I'll tell you 87, 2000 wasn't pretty, and I think a time is coming that might make those times look pretty good. I can only hope that that doesn't happen, because it will bring a lot of destruction and ugliness to the party everyone is enjoying. We are all living great, life is great, everybody happy, plenty of money as wherever you look at, so let's just keep on partying. As long as the Fed can lower rates, inflation is at 3%, who cares, let's push that, everybody, don't stop the party. The expectations are for lower rates, Trump wants them even lower, he might get what he wants. The key risk is therefore that the low rates party will finish. And if you look at what Warren Buffett has been doing, he's completely in cash. Now, 2025, we don't know whether the party might finish, but he assumes that the party will finish. I hope both Warren Buffett with his cash position and Icahn and all those old-fashioned investors are totally wrong, and that this time it's really different. And that all of you investing in BlackRock make 2x on things going well, 2x on money being printed, the government buying assets, whatever, because if there is a crash, recession, this, that, rates can go lower, they're simply printing to inflation to pay the debts, and that's it. Financial assets will go up and everybody makes money. However, I have just this value investing thing in me that doesn't allow me to make money on that. We'll discuss that even tomorrow, how I want to make money. For me, that is important. You can just take this and make your money. So I'm going to put here BlackRock on our educational YouTube value investing quadrant. If you want to see how I make money, hopefully not by hosing you, you can check my research platform. Thanks for watching. I'll see you in the next video.